Welcome to Breaking News to Trading Moves. We're starting today with a single piece of news out of Hewlett Packard Enterprise, that's HPE, and it really gives us a clearer picture of capital spending in the tech sector right now. I mean, when a company that big, a major player in enterprise hardware, comes out and resets expectations, it's a very useful way to see where the money is flowing.
Or where it's not flowing, which can be just as important.
Exactly. And crucially, where it's stalling out.
That's right. You have to remember, HPE is they're so deeply embedded in the core infrastructure of, well, almost every modern data center. They provide the physical servers, the storage, the hardware that powers everything from old-school databases to the most advanced AI models.
So their guidance, their forecast, it's almost like a barometer for the industry.
It is. It's not just about HPE's own performance. It tells you something about this spending mindset of chief information officers, CIOs all around the world.
So let's lay out the premise here. HPE projected that their next quarter's sales would come in below what Wall Street analysts were expecting.
And they were pretty specific about the reason why.
Right. The main driver they pointed to was a slowdown in income from their AI server business specifically.
And this is where the details really matter. The explanation they gave is key. HPE said the slowdown was because many of their biggest customers, the ones placing these huge multi-million-dollar orders, they're delaying the shipments. They're pushing these orders into the second half of the year.
And that distinction is everything, isn't it? A delay versus an outright cancellation?
It is the crucial difference. It's what determines who wins and who loses from this news. One means the project is dead. The other means the payment schedule is just changing.
So that's the critical piece of information here. The market has to decide, are these customers giving up on AI? Which, that seems unlikely.
Very unlikely.
Or are they simply pausing the physical delivery, pausing the payment schedule for these big hardware purchases? So today, our mission is to look at the market's reaction to that hesitation. We'll start by looking at the companies that could actually gain from this, the beneficiaries of a hardware delay.
Yep.
And then we'll get into the companies that are facing some pressure because of this pause in big hardware buys.
And what we're seeing is a really clear picture of what happens when capital expenditure, CapEx, the money you use to buy physical things, when that slows down. It causes this immediate pivot toward operational expenditure, or OpEx. That's the money for services and subscriptions. And that pivot, well, it creates some instant winners.
And at the same time, it causes friction for other hardware vendors who are counting on that steady flow of CapEx money.
Exactly.
Okay, so let's start with those winners. Let's look at the companies that benefit when enterprise hardware budgets get a little tighter or, a big AI server purchase gets postponed.
There are a few groups that seem to be positioned well in this kind of environment. They either offer a very tactical, immediate solution, or they provide something so foundational that it's sort of insulated from these short-term delivery issues.
We've got three clear categories here. The first, and probably the most immediate beneficiary, would be the public cloud and AI platforms.
Right.
Let's just, walk through the dilemma from a CIO's perspective. A company knows it needs a ton of AI compute power right now to stay competitive.
They can't wait.
But for whatever reason, they're pausing the financial commitment to buy the physical servers to run it in their own data center. So what is the fastest, easiest way to keep that AI project moving forward?
The fastest path is always renting. It's that tactical pivot to OpEx we just talked about. When a CIO hits the brakes on committing all that capital to buy their own dedicated AI servers, they're pausing CapEx. But like you said, they can't afford to just stop their AI development. The need for that compute power is now.
So they shift the expense.
They shift it from buying the asset to renting the service. It's that simple.
And that rental model, that money, flows directly to the big public cloud providers. The names identified here are Microsoft, ticker MSFT.
MSFT.
And Amazon, ticker AMZN.
And specifically, you're talking about services like Azure from Microsoft and, of course, Amazon Web Services, or AWS from Amazon.
Right.
And the financial choice being made here is it's so critical. AI development isn't a nice to have anymore. It's a necessity. It's driven by competitive pressure, this race to get products to market.
So if I'm a developer and I need 1,000 GPUs to train my next model.
Exactly. And HPE, or Dell, ticker DELL, tells you that the delivery window just stretched out from 3 months to 9 months. You can't wait. You just can't.
You go somewhere else.
You just go to Azure or AWS and you
Yep.
spin up that capacity immediately, maybe that same afternoon.
And it's not just about waiting for a server to show up on a truck. Buying an AI server is a huge commitment.
It is a multi-layered commitment.
You're talking about clearing out floor space in your data center, maybe upgrading your cooling system,
Almost certainly upgrading the cooling and power.
hiring or allocating IT staff who know how to maintain these, very complex, power-hungry machines, and then you've got to deal with a multi-year depreciation schedule on your balance sheet.
And renting just avoids all that headache instantly. It gives you a flexibility that a big capital purchase just can't match, especially not in an environment with this much uncertainty.
That's a great point, the risk factor.
Think about the risk. If a company commits, say, $10 million to a server purchase, and then their AI project changes direction, or worse, it doesn't deliver the return on investment they expected.
That's a sunk cost.
It's a sunk cost. They own the hardware. But if they're just renting that capacity from AWS, they can just turn it off. They can terminate the subscription probably within hours.
So the ability to scale up or down is incredibly valuable.
The scalability and the descalability is highly, highly valuable to a CIO who's facing budget uncertainty.
So this dynamic, it really confirms two things for us. First, the demand for AI compute power is still very, very robust, no signs of stopping.
None at all.
And second, the preference for how you get that power owning versus renting, it's extremely sensitive to these kinds of logistical problems, which is exactly what HPE's delivery delays are.
And that sensitivity gives the public cloud providers tremendous tactical leverage. They're positioned as the instant solution, the safety net, really, the reliable place to get compute power when the old-school enterprise hardware supply chain falters.
So if you're Microsoft or Amazon, you're capturing all of this immediate, almost impatient demand from companies facing deadlines who just got told their hardware is 6 months late.
Yeah, you are. It's the difference between waiting for a specialized factory to produce a custom machine versus just, instantly provisioning virtual capacity from this massive, already built warehouse of servers.
When time is money, the choice is pretty clear.
It is. The delay in physical delivery basically acts as a business accelerant for the cloud providers. It forces companies to rely on OpEx for longer than they might have wanted to, which, might even make them more comfortable with that subscription model over the long haul.
Okay, let's move on to the second category of beneficiaries, the AI chip and data center infrastructure suppliers. This group benefits from that nuance we talked about at the top, that this is a delay in delivery, not a cancellation of the project.
Right.
This suggests the long-term plan to build out AI infrastructure is still fully on track, and it's sort of insulated from these short-term server delivery problems.
That's the pivotal insight here. That's what the market is pricing in. The street seems to be reading HPE's guidance as a short-term logistical problem inside a much larger multi-year plan for building out AI.
So if those big deals are just being pushed out by a few months,
then the need to get your hands on the foundational components for those deals remains immediate. It might even become more urgent because you don't want another bottleneck later.
Okay, so who are we talking about here? The names that come up are NVIDIA, ticker NVDA, and Vertiv Holdings, ticker VRT.
Let's start with NVIDIA, NVDA. They are the main supplier of the specialized AI chips, the GPUs. I mean, they're the core intelligence that makes an AI server an AI server.
And their supply is famously tight.
Extremely tight. So regardless of when the physical server box from HPE or Dell finally gets to the loading dock, the supply of NVIDIA's high-end chips is finite. It's often allocated many, many quarters in advance.
So the market is basically betting on a continued long-term commitment to this AI build-out. A 6-month server delay for a few customers doesn't really change the scarcity of the chips themselves.
Not at all. It doesn't change NVIDIA's long-term sales roadmap. It suggests the demand for that one component, the chip itself, is essentially decoupled from the immediate delivery schedule of the physical box it sits inside.
The enterprise customer knows they have to get their chip allocation secured now.
Right now. Even if they're not ready to pay for the full server until the second half of the year, NVIDIA's revenue visibility is less tied to the specific quarter a server gets delivered and more tied to those long-term order commitments and just the raw competitive need to acquire GPU power.
They sell the core ingredient, which is sort of immune to the logistical delays of assembling the final product.
You could say that, yeah.
Okay, now what about Vertiv, or VRT? They're identified as a supplier of power and cooling specialists. Let's get into the technicals here. Why would they be insulated from a server delay?
It really comes down to the physics of AI. It's just simple physics. Modern AI accelerators, especially when you pack them densely into these specialized servers, they generate an incredible amount of heat,
Far more than traditional servers.
exponentially more than the old CPU-based servers. So we're not talking about just, cranking up the air conditioning anymore. We're talking about advanced precision cooling infrastructure, things like liquid cooling systems, specialized distribution units, and just massive power management systems to handle it all.
And that kind of infrastructure, the stuff you need to physically host and power and cool these AI clusters, that has a really long lead time to build.
An incredibly long lead time. You're talking about huge electrical upgrades to the building, pouring new concrete floors to support the weight,
Yeah.
setting up complex plumbing for liquid coolants.
It's a construction project.
It is. It's a full-on construction project.
Yeah.
So if a company knows they will be deploying 1,000 of these delayed AI servers in, say, early 2025, they have to start laying that infrastructure groundwork right now in 2024.
Because the timeline for that physical plant, the plumbing, the chillers, the power, it's much longer and more complex than the assembly timeline of the server itself.
Much longer. So even if the server delivery schedule slips by 3 or 6 months, the construction commitment for the supporting infrastructure, that's Gertrude's business, that stays urgent. You can't just speed up the process of pouring concrete because your server showed up late.
So the investment in this area is locked in. It's a multi-year engineering effort.
Absolutely. So delays in server delivery do not mean there's a delay in securing the necessary power and cooling infrastructure. In fact, you could argue that if the company's using the delay to make sure their facilities are perfectly ready, Vertiv might actually see their own delivery schedules get pulled forward.
Okay, so that makes sense. Let's move to our third and final winner category, which reinforces that trade-off we've been talking about.
The CapEx versus OpEx.
Right. The temporary freeze on CapEx budgets pushes money toward OpEx. And we're looking at asset-light software and data platforms. The goal for the CIO is to keep productivity up, keep the business moving, even if the hardware budget is on hold.
That's the essential calculation they're making. If the company can't buy new hardware, that's the CapEx constraint, they have to find other ways to spend their budget that generate immediate measurable value.
Without requiring any new physical assets.
Exactly. And that creates a natural pull towards subscription platforms.
And the names that have been identified as benefiting here are Salesforce, ticker CRM, and Snowflake, ticker SNOW.
Right, CRM and SNOW. They both provide core business software and data platforms through a subscription model. And the reason they benefit is pretty straightforward. They deliver value through software access, which is an operational expense.
It requires zero upfront capital spending on hardware.
Zero.
Yeah.
And that makes them a very attractive alternative when the hardware procurement process is stuck.
Let's talk a bit more about their value proposition in this scenario. If a company pauses its multi-million-dollar on-premise server purchase, well, its sales team still needs Salesforce to manage customer relationships.
Of course. And its data scientists still need a platform like Snowflake to process and analyze all their data for business intelligence or for training new AI models. The work doesn't stop.
And crucially, these are services where the return on investment can often be tracked almost immediately.
A CIO can point to real, tangible gains in sales efficiency or data processing speed and use that to justify the OpEx spend. It's inherently less risky than a massive CapEx purchase.
Which is harder to undo.
Much harder to unwind, and its ROI might take years to show up as it amortizes. A subscription model offers a low-commitment, very flexible way to use the data and the workflows you already have.
So it's really a way of maintaining technological momentum.
That's a good way to put it.
The push to use AI and data for a business advantage, that can't be paralyzed just because of a hardware delivery delay. So the money that was allocated for tech productivity just gets redirected.
Away from physical assets and toward subscription services that you can deploy instantly and scale up or down as you need.
So to quickly summarize the winners, the market seems to be reading HPE's news as a delay in enterprise CapEx, not a full retreat from AI.
Right.
The beneficiaries are the public cloud providers, MSFT and AMZN, who rent out capacity. Then you have the essential long-term suppliers like NVDA and VRT, whose deployment timeline is just longer than the delay itself.
And finally, the asset-light software companies like CRM and SNOW who do well when spending moves toward operational expenses.
Okay, so now we need to pivot and look at the other side of this.
Right, the companies facing pressure. We need to look at who is seeing some potential downward revisions in sentiment as a direct result of the HPE guidance and this delay in AI server spending. And this news, well, It creates some predictable but definitely challenging headwinds for a few related groups.
And the first group is the most obvious one.
The most directly impacted, yes.
Right.
Enterprise AI server and storage makers. The entire reason we're having this conversation is because customers are delaying these AI server projects.
So that immediately creates concern among investors. Concern that the near-term demand for on-premise AI hardware is going to be weaker and maybe a lot less predictable than people had previously modeled.
Exactly. And the companies right in the line of fire, of course, HPE itself, ticker HPE, and its main competitor, Dell Technologies, ticker DELL.
Both of them are massively reliant on selling these high-margin, specialized server units and the storage that goes with them into corporate data centers.
And the main risk factor here, and this is so important for understanding the volatility, is this phenomenon called lumpy demand.
Lumpy demand.
Lumpy demand. For any company that sells physical goods and relies on a complex global supply chain, lumpy demand is it's a destroyer of efficiency. Lumpy just means the demand is inconsistent. It's unpredictable. It comes in these big, irregular bursts instead of a smooth, predictable stream.
Okay, so why is that so damaging for hardware giants like Dell and HPE specifically?
Because their entire operation, their whole manufacturing and supply chain, is built around high-volume, continuous production. Smooth demand lets you plan everything efficiently.
You can predict component lead times.
Schedule your factory utilization, lock in contracts for parts, manage your workforce levels. But when a big chunk of your orders suddenly get delayed by 3 to 6 months, it just creates immense volatility in your inventory management.
Can you walk us through the financial mechanics of that? What does that lumpy demand actually cost them on the books?
Well, think about the components. They've already committed to buying all those specialty AI chips, the high-speed memory, the custom server casings, all based on the original delivery date the customer gave them. When the customer delays that order, all that inventory just sits on their balance sheet. It's not going out the door. So that leads to bloated inventory levels, higher warehousing costs, and worst of all, you run the risk of inventory write-downs if the technology gets updated or if the customer, down the line, ends up canceling the order entirely.
And then there's the other side of it. When that delayed order finally comes through 6 months later, they might not have enough components ready because they reacted to the slowdown by cutting their own orders.
It's a vicious cycle of over and under reacting. And that frustrates the customer who is already annoyed about the first delay.
So this lumpy demand, it hits both their revenues because sales become erratic and hard to forecast from quarter to quarter, and their profit margins.
Both. The entire group focused on enterprise AI hardware is now under pressure because their business model depends on efficient volume or predictable quarterly delivery cycles. The market is looking at HPE's experience as a canary in the coal mine.
A sign of broader customer hesitation.
A sign of broader hesitancy in committing capital to these really big, expensive server installations right now.
Okay, so our second area facing some pressure is the adjacent hardware market, data center networking hardware. It seems the pain from the server delay spreads outward pretty quickly to all the supporting gear that's physically dependent on those core servers.
This is a classic example of operational dependency in enterprise IT. It's textbook. Servers are basically useless by themselves. They have to be connected to each other and to the wider network to function as a compute cluster.
So slower server rollout.
Translate almost instantly into slower orders for the networking equipment that supports them.
We're talking about the high-speed switches, the routers, all the networking gear that physically surrounds those server racks. And the names identified here are Cisco Systems, ticker CSCO, and Arista Networks, ticker ANET.
Yes. And the sequence of how you deploy this stuff is it's fixed. You can't change it. If a customer delays the arrival of 100 AI servers from HPE, they have absolutely no reason to take delivery of the high-speed networking switches they need to link them all together.
So just sit there.
The IT department does not want expensive networking gear sitting idle in a box on a loading dock for 6 months. It's consuming inventory space, it's aging, just waiting for the main hardware to show up.
It's purely a matter of project timing. You only order the networking layer when you know the primary hardware deployment date is locked in coming up soon.
So for traders, the market dynamic is very straightforward. They mark down the expected near-term revenue for a CSCO and ANET based on the exact same underlying theme of postponed server deployments.
They're essential links in the chain.
They are. But their near-term revenue is completely dependent on the speed of that CapEx commitment to the core server infrastructure. If the core slows down, the surrounding networking hardware inevitably slows down right along with it.
And Arista, ANET in particular, they're often seen as a leader in providing the really high-speed, low-latency networking that these specialized AI workloads require.
That's their specialty. So if AI server deployments are getting pushed out, the visibility into their immediate revenue stream declines pretty sharply. That puts pressure on their short-term sales forecasts, even if their long-term technology is still top-notch.
It just shows how a delay in one core product, the server, immediately translates across to related equipment sectors. Investors are quick to recalibrate their expectations for these dependent companies.
They are.
Okay, that brings us to our final category, which introduces a very specific logistical and budgetary issue affecting a particular sector. HPE specifically called out a weakness in United States federal spending on servers.
Right. That's a very explicit red flag about the purchasing habits of the public sector.
And the government operates under these very unique budget cycles, right? They're driven by congressional appropriations, political processes. It can lead to delays that have nothing to do with the actual technological need.
That's right. So when HPE goes out of its way to point out weaker federal spending on servers, it signals a slowdown in either the willingness or the ability of the public sector to make these purchases, and the market pays very close attention to that.
So why does this weakness spill over into market sentiment for government contractors? The names identified are Leidos Holdings, ticker LDOS, and Science Applications International Corporation, ticker SAIC.
Well, LDOS and SAIC are huge government contractors. Their entire business relies on executing these large, complex government tech projects.
They design and integrate these systems.
Right, the design, the integration, the implementation, and then the long-term maintenance of the exact kind of on-site hardware installations that HPE is having trouble selling. These contractors build and staff the custom IT systems for all sorts of federal agencies, from the Department of Defense to, administrative bodies.
So the market connection is this. If the government is hitting pause on buying the core servers, the foundational CapEx, then it stands to reason that the big lucrative service contracts to install and integrate and maintain those servers are also getting delayed or renegotiated.
That is precisely how the market reacts. Weakness in the public sector's buying of the underlying hardware is treated as an indicator for broader risk among these major government IT contractors, even though Leidos and SIT are primarily services firms.
Their services revenue ultimately depends on those big hardware projects actually happening.
Absolutely. If the federal budget for a new high-security data center gets pushed back 6 months because of some appropriation delay in Congress, well, the massive services contract to staff and operate that data center gets delayed right alongside it. The CapEx delay directly impacts the future OpEx opportunity.
The uncertainty is the killer here, isn't it?
It is. While federal contracts are usually seen as very stable, they are highly sensitive to things like government stop work orders or budget reallocations. HPE's specific warning acts as an early signal that the federal CapEx environment just isn't as robust as people thought.
And that puts immediate pressure on the near-term valuations of contractors like LDOS and SAIC.
It does. They get penalized because their business is tied not just to the tech cycle, but also to the often erratic political and budgetary cycles of the federal government.
So this has given us a very clear picture of how the guidance from just one major company can really illuminate the immediate winners and losers across the tech supply chain. We've seen a clear reaction where a single event is forcing a temporary redirection of capital.
And the core takeaway is still this. A delay in CapEx for physical servers has caused a powerful chain reaction. But it's less about AI progress stopping and more about changing the immediate method of how AI projects get funded.
Enterprises are showing an impatience for results. They're not willing to wait for hardware delivery.
Not at all.
And the beneficiaries, as we said, are those offering services, the flexible cloud rental models from MSFT and AMZN, or those selling the essential long-term infrastructure components like the AI chips from NVDA and the power and cooling systems from VRT.
Right. Those businesses are proving to be resilient against the immediate logistical and financial pressure that's affecting server deliveries.
And on the other side, the companies facing the most immediate pressure are those selling the physical hardware itself. HPE and DELL, and the networking gear that depends on it is CSCO and ANET.
And of course, that specific government spending weakness creates unique risks for the IT contractors like LDOS and SAIC. The market is making a very sharp distinction between this short-term transactional volatility and what it assumes is still a very strong, long-term structural demand for AI capacity.
The overriding theme is that temporary flight from CapEx ownership to OpEx rental and subscription, and it's driven purely by logistical necessity and these delivery delays. It just highlights that when companies run into bottlenecks, they prioritize flexible, pay-as-you-go solutions to keep their tech goals on track.
And that leads us to a final thought for you to consider as you process all this.
Yeah.
If this current pattern of delayed server orders continues,
Mhm.
so if enterprises are renting their AI capacity from Microsoft and Amazon for a lot longer than they originally planned,
Right.
how might that alter the long-term negotiating leverage? Will the public cloud providers who are benefiting so much from these rentals gain permanent control over pricing and access? Or will the desire of these enterprise customers to eventually own and amortize a multi-million-dollar asset bring them rushing back to the physical server makers once the supply chain finally stabilizes?
That's the real tension, isn't it? The cost of flexibility versus the security and long-term cost-effectiveness of ownership. We're basically watching a negotiation play out in real time, with physical delivery timelines acting as the mediator. Thank you for joining us for this examination of the news and how market dynamics can play out in response to a single guidance reset. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.